Hello from the Dukascopy TV studio in Geneva. I'm Daniel Schwenger. Alongside me to discuss the current oil price, the reasons and the impact factors is Lorne Baring from B Capital in Geneva. Lorne, welcome to the studio.
Good morning.
There has been a sharp fall in oil prices since June this year. To what extent do political factors, but also demand and supply side economics play a role in this?
Well, you're quite right. There's probably three parts to the story behind the oil price crash. The first one is a weakening demand story. Global growth has been revised down over the last couple of months, and that has really softened the picture for oil in general. But the real story, in our view, is that there's oversupply. Nearly everybody is producing a lot more oil. This year, the US has increased oil supply domestically by a huge amount, as much as 30%. OPEC, as we know, recently decided not to cut in the recent November meeting. The result is that more and more oil is coming into the market. There's a weak demand picture, and that naturally pushes the oil price down. The third part is probably a political move. As the US becomes independent for its energy needs, the OPEC producers are thinking, where is the next big client? And it's probably Asia. So as a result, Saudi-led OPEC is thinking, how can they grab market share? Well, they're going to go on a discounting spree, and that's possible for Saudi because they have huge foreign reserves and a quite efficient cost of lift. So they're able to cope with the price dropping and not too worried. As Ali Al-Naimi said last week, the Saudi oil minister, why should I cut? And that really sent the oil price off a cliff.
There is a relationship with the oil price and the US dollar. So why does this relationship exist? Does it still exist?
Well, global oil is priced in dollars. So the dollar-oil relationship is inverse, and we are seeing the US strengthening. There is a possibility of rate rises coming in the US. They may not be as soon as everybody thinks, but certainly the dollar is getting stronger, and that typically has an inverse effect on the oil price. But it's really the supply and demand story, particularly on the supply side, in our view, that's hitting the oil price right now.
The current downtrend of the euro also seems to coincide with the oil price. How comes that into play? Well,
first of all, it is the dollar and the dollar economy, which is doing better with the possibility of rate rises there. And so with a high yield, there's the carry trade. We're probably looking at quantitative easing in Europe. The likelihood is that there'll be loose monetary policy going on for longer in Europe. There's also the inflation and deflation argument. There really is no inflation around the world. Most central banks and governments are looking for around 2%. In many places it's less than that, and in Europe it's almost at zero. I think CPI yesterday was about 0.2 or 0.3. That means that it's likely to be a weakening story for the euro, which is good for Europe. So there's the dollar America, euro Europe story. The lower oil goes, the more that feeds into deflation. And so the more deflationary the picture, the more it's going to depress the euro. And so I think that there's a combination of factors there. The third one is geopolitical as well. On the border of Europe, we have Russia, and the problems in Russia can naturally cause a contagion effect. So there's a combination of sort of macroeconomics and geopolitics, depending on which way you look.
So what's your prediction for the next weeks to come for 2015 and the beginning?
Well, on the global picture, I think that GDP will probably come in at around 3.4%. There is a benign effect of lower oil prices, which should feed through. We clearly don't want to see oil moving in such great ranges as we've seen recently, because it destabilizes all financial markets. But if oil stabilizes at a lower level, and we think it probably will remain in a lower band than most people have predicted, probably sub 80, possibly even sub 70 on WTI, that will feed through and will benefit, for example, US consumers. On the supply story and the oil price, our prediction is that the band will be lower. There won't be a recovery back towards $100 oil anytime soon. There is a number of new producers who are coming back, Libya, Iraq, Kurdistan, etc., all producing oil in relatively strong increments. And although oil demand is around $90 million barrels, the growth side on supply is several million barrels above that. And so the oil price will probably be kept down, and that's probably what Saudi wants to do as well.
Lorne Baring from B Capital in Geneva, thank you so much for sharing your expertise with us today.
My pleasure.
And thank you for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day and see you next time.